Well, you know I'm a price guy, and I listen to all the same remarks that all the people make the same way that you do, but I do exactly nothing with that information. I focus instead on what's actually happening, because price is truth. And where the rubber meets the road, what you're seeing today in the market is very clear-cut. The most cyclical sectors are substantially underperforming, and the most defensive sectors are leading. So you have this nascent rally in consumer staples and the XLV names, while energy stocks are the most hard hit. And that kind of a day just speaks volumes about where the market's head is at in terms of the economic concerns. That trend could remain in place for a while. And there are going to be these like regular reversals of that trend. Some random Wednesday, all of a sudden, the ARC stocks are leading, or all of a sudden consumer discretionary catches a bid, but the trend is down. So those days are counter trend, they're noise. The bigger picture trend is down. And I think it's really tough for people Monday, Tuesday, Wednesday to like compartmentalize these mini rallies they see that give them hope. The big picture here is there's a ton of indecision. The best chart I saw today came from Sentiment Trader. Shout out to Jason, who notes that market volatility over the last 5 weeks is at its highest since the COVID lows and the 08-09 period. He's measuring market volatility by the number of 5% changes. We've had 4 plus or minus 5% changes in the last 5 weeks. The last time we've seen that, the only period with more of those is 1928. I don't mean to use that date ominously, but like there's just a ton of indecision, and in the presence of this much indecision, don't be surprised to see defensive stocks have the leadership position.
That is true, the most since 1928, but he also points out that the other times when you've seen this clustering of 5% weekly moves have been toward the end of bear markets, which is not to say it's some kind of signal, but it's the kind of dramatic action that you see when the market is really kind of coming to terms with a potential trend change or inflection point, or just, you know, some kind of liquidation, I guess, underway. So it's interesting. We've seen so many extremes happening, and I just wonder how to really put them in context. You know, we saw so many on the way up from the March 2020 low. For the next year and a half, all we did here is say this market's never been stronger in a shorter period of time than it has been recently. And people would say in 2021, why is the market up again? Well, the same set of factors that made it go up yesterday. And so to your point, I think it's the ongoingness of the same challenges that has the market in the current downtrend, which maybe doesn't help anybody in terms of the practical matter of whether to act, and if so, how.
So I disagree. I think it's helpful to understand where we are for both groups of investors. For short-term investors who are putting on long-side trades, in this environment, we're in a defined downtrend. 10-month moving average is negatively sloped. We know this. This is actually one of the only things we know for a fact.
Yeah.
We know the S&P 500, the Dow Jones Industrial Average, the Dow Transports, the financial sector stocks, the NASDAQ, small cap 600, Russell 2000. We know for a fact that these are all in bear markets. So if you know that that's the environment, what are you doing with your short-term trades? You're probably working with tighter stops. You're probably not buying 10 ideas at once. Maybe you focus on your top 3, because there's no room for all of this debris in a portfolio. So there are definitive things that you would do as a short-term trader, knowing that we're in this environment. As a longer-term investor, at my firm, we manage some of our assets in a tactical portfolio. What does that mean? We were out of NASDAQ at the end of February. I said it on the air. We were out of S&P 500 at the end of April. I said it on the air. Why were we out of these things? Not because I have any better idea than Jay Powell about when inflation will peak. It's because we're in a defined downtrend. And when you are statistically in these defined downtrends, the other thing we know for a fact is that historically, the rates of returns are lower. Volatility is higher and returns are lower. Now, this will change. At some point, this will bottom. The moving averages will turn higher. The trend will turn higher. It'll be really hard to see that happening in real time. But there's no evidence that that process is underway yet. So why act as though it is?